Shocking, real estate investors lost millions by ignoring this critical market relationship. Cap rates and interest rates are closely linked, yet many investors overlook this fundamental connection. When interest rates rise by 1%, cap rates typically follow with a 0.5% to 0.75% increase. Here's why this matters. A property generating $100,000 in net income at a 5% cap rate is worth $2 million. But when interest rates push cap rates to 6%, that same property is suddenly worth only $1.67 million. That's a $330,000 loss in value. The relationship exists because real estate competes with other investments. When bonds and treasuries offer higher yields, investors demand higher returns from real estate too. This forces property values down until cap rates rise enough to match risk-adjusted returns elsewhere. Smart investors use this correlation to their advantage. They buy when interest rates peak, knowing cap rates are likely high, and sell when rates are low, capturing maximum property value. Pro tip: watch the spread between cap rates and 10-year Treasury yields. Historically, this spread averages 3%. When it's significantly wider, real estate might be overvalued. When it's tighter, you might find good buying opportunities. The takeaway: never evaluate a real estate deal without considering where we are in the interest rate cycle. Your investment returns depend on it.